Hello, I'm James Robinson, and this is my stock pick of the week. This is my third in the 5-part series on the company George Risk Industries, symbol RSKIA. Today we're going to be looking at the company's balance sheet. What I'm looking for in the balance sheet is really a measure of risk. The more debt a company has, especially debt relative to cash, the more risk there is something can go wrong. Also, I look at the balance sheet as a litmus test for a well-run business. A well-run business should have cash in the bank, should have very little or no debt. If they have a bunch of debt, that probably means that they're not able to fund operations and growth as a result of their cash flows, and that's why they're borrowing money. And I like companies that are generating enough cash flow to more than compensate for their needs to grow the business. So that's what we're trying to look at when we look at the balance sheet for a company. The first thing that I look at when I'm looking at a company from the balance sheet point of view is I try and get a sense for total current liabilities and total long-term debt. Generally speaking, your total current liabilities, that's money that you owe in the next 12 months. And then long-term debt is money that you owe in 12 months or more. And those two combine to give me a sense for what the real debt picture for the company is. Generally speaking, you'll see total current liabilities increasing over time. That's as the business grows. They take on more costs they have to utilize to operate the business. So an example of a current liability might be payroll, right? If you've got to made a payroll, then that's going to be a liability that's not yet paid. And as your company grows, you'll have more payroll as an example. So what we're looking at here is a company that has, it looks like the total current liabilities are going up in a relatively straight line, not too steep, not steep relative to earnings. So that's good. Total long-term debt also looks like it's going up, but that's a bit of a misnomer. In this company, from what my research has shown, there's no real debt. There's no third party to whom they owe money to, like a bank or a bondholder. What is standing here in total long-term debt is unrealized capital gains for which there will eventually be a tax obligation. And so that's what's showing up here. And it's, by the way, $3 million, and the company has $40 million in cash. So it's a non-issue, but it's something you wanted to discuss. And I wanted to make sure you understand, because all throughout this presentation, I'll be talking about how we have no debt. But if you look at this, you'll see it looks like we have this $3 million, and that's not really what it is, because until we sell our stocks, until this company sells its stocks, it doesn't owe those taxes. The next thing I look at is cash equivalents and marketable securities. And you can see this company is sitting at about $42 or $43 million of cash. The whole company is $85 or $90 million. So we're getting the business for 50 cents of the price of the business is matched up. 50% of that cost is the cash that's on hand. So that's wonderful. Also, it's been going up gradually every year since 2006. One could argue there's too much money there, that money should be paid to the shareholders. As long as they do an intelligent job of investing the money, I don't mind them keeping it. Obviously, if that money wasn't being used intelligently, we'd want to get it back as the shareholders. But as we've talked about in the overview, you're not going to have somebody come in like Carl Icahn and rescue that money and force the management to pay that to you, because the company's more than 50% owned by the Risk family, and they're going to do what they want to do. And what they seem to want to do is keep this money in cash. And again, I've been okay with the return they're getting, so I'm willing to live with that in exchange for the safety of knowing this company's completely bulletproof in terms of their balance sheet. The next slide that I look at, and this gives me a sense for the short-term safety of the business, is current assets and current liabilities. So we talked about this with the current liabilities slide, the first slide. Current means it's in the next 12 months. That's what the word current means in accounting. So current assets is how much money we're going to owe people in the next 12 months. And that's the red line, which is obviously very, very low. And then the next one is current assets, which is money we either have or will have in our bank in the next 12 months. And you can see that we are, closing in on $60 million of total current assets. So long story short, there's nothing going to happen in this business going to infringe on its ability to operate and to pay its bills for many, many years into the future. When you look at the when you look at current assets in relation to current liabilities, you come up with the current ratio, and that's basically current ratio is how many total dollars of current assets do you have relative to your current liabilities. And you can see we're hovering at about 13, which is spectacular. The red line here is the top 10% of all companies, And so we're way, way, way above that. This company has far more cash on hand than they can justify a need for. So that's why that cash has to be invested intelligently, or it's squandering the shareholders' money. But I think they've done okay in terms of investing it. And so again, we just look at this as a bulletproof balance sheet. So let's look at the interest payments and interest income sheet here. And there's a little nuance we need to discuss. First of all, in terms of interest expense, the company has virtually no interest expense. It's probably not exactly zero because they've got some credit card, for travel and expenses that they might pay some money on or something, but it's a negligible amount of money. The interest income needs to be explained because they show no interest income, and that's not completely accurate. They own $7 million worth of municipal bonds. They have a little bit $1 million in a money market, and that is generating interest income, but it's tax-free interest income. And as a result of it being tax-free, they've broken it into one line they've broken one line down for interest and dividend income combined. They didn't break them out as to which is which, and so it's not showing up on my sheet. But they actually do have a little interest income, and it's on $7 million. It's probably in the area of $350,000, and again, that's tax advantage because it's a muni. But just a little nuance to be aware of that might not show up on this chart. Long story short, they're not paying any interest, and they do have interest income. The next chart is really important for companies that have debt because it allows us to put the debt that the company has and quantify it in relationship to the earnings that the company has, right? So what we basically said is if a company makes $1 million and they have $500,000 of debt, then it would take them 6 months to pay off the debt. And you can see here, this is the ability to pay off the debt for this company is measured in months. And they're a fantastic company that basically has no debt. One of the things to talk about is that the balance sheet section of these videos is often very short because so often I'm buying companies that have absolutely no debt or virtually no debt. What's fascinating is if you look at the average company, there's an awful lot to talk about on the balance sheet because there is a ton of debt and you want to look at it from multiple angles. But all that obviously is made very easy for us if the company has no debt in the first place. And here we go again. This is looking at interest expense in conjunction in relation to the operating income. And when you're not paying any interest expense, you're obviously bulletproof and have nothing to report on this slide. But the other thing that I would point out is that it's very, very consistent. I mean, it's been that way since 2013, and really it's been that way since 2006. It's not just that the company just managed to pay off all their debt last week, it's that they've never had any debt. And that gives you pause as a long-term investor that trend is likely to continue for the foreseeable future. And also, by the way, it would give you pause if all of a sudden you saw the debt start to pick up. You would have to ask yourself, well, what has gone on? What's changed? Why is this company suddenly doing something it never had to do before? So sometimes what's not in this chart and what are in this chart are telling you things that might not intuitively make sense at first.